Hey everybody, Charting Man Dan here. We're going to do a bad trade review. We had a member on the last trading day of the year get himself into a sticky situation. I asked him if it would be alright if I did a video discussing the risk to reward scenario that played out and what went wrong with the trade, and he was happy to oblige and even typed up this review here. So what I want to point out first thing is if every one of us did this kind of analysis of our trades, both winners and losers, we would all be significantly better traders. So you might be sitting there, if you're struggling a bit, wondering what you can do to improve, look at the detail that he went back into this trade, analyzing the situation, seeing exactly what he did wrong, and that helps us learn from our mistakes and move forward into the future. So let's get right into it, looking at how this set up. He had a good start to the day. He was up to 672, and I'll skip ahead. After getting back to my computer, I became aware of an interesting opportunity. So we had the stock LEI. It had made an announcement that caused the stock to rocket up from $125 to over $10 for over 500%. So I want to stop right there and point out that if a stock has already run multiple percent, that multiple hundreds of percent, that means that it is a thinly traded stock, which means that the bottom can fall out, the rug can get pulled out from shareholders or investors, traders, and it can very quickly consolidate. That's obviously what happened in this trade. But if a stock has already run up multiple hundreds of percent and you're looking to scalp a few $100s, the risk to reward is not in your favor in that scenario. You're looking for a few hundred, and the risk is the inevitable of what happened here, multiple $1,000 loss. But that is because after running so high up, there's going to be a lot of traders looking to take profit. And with it being thinly traded, being able to move up 500%, that means it's going to move down just as quickly. I know that some people say that stocks go down twice as fast as they go up, and it is certainly an example that happened here in this case. So stock was up 500%. He took a look at the stock and decided he was going to short it. So he went to his account, saw that he could not find the shares for shorting. So not wanting to miss out, he did the next best thing and bought the dip. So another little red flag there, not wanting to miss out. You see all the money that's being made. Everybody's all pumped up about the stock. At that point, the hype certainly can draw you in, but it's important to remember how many opportunities there are out there, how many different stocks there are making moves every day, how many trading days there are in the year, and feeling like you're missing out on one play that's already run multiple hundreds of percent can suck you into a situation where you want to be a part of the action and the fun, and you have already missed the opportunity at that point. So as it was consolidating, it was bouncing between $10 and $10.50, and he was trading a block of $1,000, so he needed a slight move to make it worth his while. So again, the reward, a few $100s, the risk, thousands of dollars. Risk to reward, clearly not in the favor. So he watched it at the peak and bought it on the way down. He got 100 shares at 10.15, 100 at 10.05, and 100 at 9.85. Another thing I want to point out right here is I personally will never average down on a stock. If there is a need to average down, that usually means something went wrong. So I'm not going to knock against averaging down. That's definitely a style of play that can be utilized for profit. Lots of people do it. It is more for swing trading, I would say, but it is certainly, if that style does work for you, by no means should you stop doing it. I just personally have the viewpoint that if I would ever come to the need to average down, that means something has gone wrong and I should have already been stopped out by now. Another thing to point out was the loss of $10 psychological support. That was a big one. We did break above it as resistance, but as soon as that was lost as support, that could indicate some downside. You would think that a nice round psychological number like that would hold if we were going to see higher highs take place. So the next candle ticked down. He didn't worry because it was supported by the 20-period moving average, and the sky was the limit. Obviously, being up 500%, the sky certainly wasn't the limit. This is a scenario where, as I said, thin traded. When I say a thin traded stock, I mean that the share structure of the stock means there's not a significant amount of shares. So when big volume does come in, it can cause it to increase rapidly. So that's what a thin stock means, and it means it drops just as quickly as well. So here's the chart, the 5-minute chart. This is when he started to make his entry. The next candle looked like a nice reversal and was confirmed with 2 more upward movements, so he felt confident he would be able to complete his sell at 10.20. To his surprise, he saw the stock drop in one tick from 962 down to 860. So that was the big dump. That was what I meant by getting the rug pulled out from underneath you. Just in a flash, enough profit taking and enough shorting takes place that the stock significantly drops very quickly. So at that point, without having a stop loss in place, without having a plan in place, he's left at the mercy of the stock price, wanting it to go up to recoup the losses. He was quickly down over $2,000 and wanted to recoup some of those losses, not trying to lock it in and take that end of the year loss. So he was hoping this 20 period moving average would hold, saw a nice bounce above it, but in reality it was lost and we saw a steep 15-minute drop. So at this point, in hindsight, we saw the low that was hit on consolidation and a bounce. A stop loss could have been set right below where the low was hit. And while granted it would have been a big loss, that in that instance as well, it would have prevented against the $5,000+ loss that it ended up being. So after about 45 minutes, he had given up and ate the loss for $5,400. So his account had been at 28K, and now after the loss, he's going to have to deposit more so he can still day trade on margin. So emotional roller coaster, and this is where the really good insight is, looking back at your trades and dissecting exactly what went wrong. Obviously, the big glaring one is not having a stop loss, but let's see what he said. Obviously, my day started out great. I was winning up over 10K for the month. Not a bad way to end the year. Greed kicked in. I decided to play a high volatile stock at the peak for the day. Then fear as he watched the stock drop, not wanting to take the loss. After he took the loss, beating himself up for making stupid plays, called it quits and decided he wanted to get drunk and feel sorry for himself. Lasted 20 minutes when he realized it's only money and he's up on the month and he learned some valuable lessons. So that right there lets me know that this particular member does have what it takes to be a trader. He quickly overcame his emotions and put things in perspective and realized that it wasn't the end of the world. He's up on the month and he learned some valuable lessons here. So the ability for traders to not be emotionally tied to their money, if it seeps into your real life, if you make a bad trade and you lose $1,000 on the day and your family and friends can tell something's wrong, that is not a good scenario. We want to be robots here. We are unemotional, not tied to money. Obviously, we care about it, but if it's enough to ruin our day and affect others around us, then trading might not be for you. So after all that, lessons learned, he laid them out. Plan your trades and trade the plan. Don't get sucked in by the action of the day, and that's where the hype comes in. Everybody's making money. I want to make money too. Don't turn a winning day into a losing day. If you're up 670 and you're entering another trade, at the absolute worst case scenario, you should have your stop loss placed so you lose at the maximum $600 so you're still even on the day. Only trade the first and last hour of the day. 11 to 3 is highly volatile and not worth the risk. I'm going to just disagree with that one. I can certainly agree with only wanting to trade in the first and last hour of the day. I myself, in the past, would find that my success was much greater first thing in the morning, the first hour and a half of the day, and I would be giving back gains in the afternoon. But it is the first and last hour's high volatility that does make it so lucrative, and the volatility actually shrinks in the middle of the day because of lunch and because of less volume. So opportunity is not as prominent in the middle of the day as it is at the beginning and end. So keep losses small. He had a chance to get out at 2K and then 3K, but he waited until 5K on the hopes that he would recoup some of those losses. And I've said it before, you can tell the ability of a trader by how big their losses are, not by how big their wins are. If you can minimize your losses and stay consistent in that sense, you are doing something right, and it will lead to success and consistency in the longer term. And lastly, don't make it personal. A bad trade is just that. It doesn't have to spill over to your home life or define you as a person. Suck it up and move on, and that's perfectly in line with what I just said. If it's spilling into your real life and affecting those around you because you made a bad trade, that's an emotional tie to money that might indicate trading may not be for you. I had a similar instance back early in my trading career where I lost $5,000 overnight in a stock that was delisted. That was roughly 15% of the money to my name at the time, and I was very shocked at how quickly I got over it and how it didn't wear on me. I took the lesson. Don't hold risky, low cap stocks. I believe it was a Chinese pharmaceutical company overnight. And I certainly learned that lesson, was able to move on, and that let me know that trading was for me. So I hope this is a good lesson. I cannot thank this trader enough for giving us the insight and the ability to check out his trade here. And if this can prevent anybody else from getting stuck into a trade, it would be worth your while to watch this video. So thanks for watching, and I will see you all in the chat room.